You are now listening to The Big Trade with Peter Pham, enlightening conversations for maximum market returns.
Jeremy Miller, thanks for coming on to the Big Trade series. It's been some time since we been speaking to coordinate this, and I'm happy to have you on.
Well, it's a pleasure to be here. Thanks for having me.
So, Jeremy, you wrote this fantastic book called Ground Rules, which covers basically a lot about Warren Buffett during his partnership years. Perhaps you could give a quick synopsis of what you found the value of in terms of covering this aspect as opposed to more of his well-known letters from Berkshire Hathaway.
Well, Peter, the book is really about Warren Buffett's time in 1955 to 1970 when he was running a partnership. What started as just a small group of 7 other friends and family members from whom he decided to manage money for. And he wrote them annually to try and help them understand how he was thinking about the markets. You know, he never really talked about explicitly what he was doing, very secretive, and no one really knew what was in the portfolio at any given time. But the letters were really written with the intention of describing his process and his methodology. And so I found them very rich and very interesting from the perspective of, you know, here's a young Buffett who could go anywhere and do anything, not at all constrained by the size of his funds the way he is today. Mm-hmm. And then 2, you know, it was a period in his life where he really transitioned from, you know, a pure Grahamite, you know, as the star pupil of Ben Graham, obviously the father of value investing, and really, you know, migrated more towards a quality compounder. So, you know, the book is about really, it's really carved into 3 sections. One is, you know, understanding the philosophy of markets. 2, you know, understanding some of the methods of operations, the different kinds of investments that he was making. And then 3, you know, some musings about you know, taxes and the value of being conservative versus conventional, and, you know, sort of other topics that he liked to address and use as tools to teach his clients.
Buffett's quite famous for discussing about some of the advantages of being relatively small, and I guess during this period of time, he, relative to Berkshire Hathaway nowadays, he was actually able to be much more agile in terms of his investments. I don't know if you had a chance to extrapolate what that competitive advantage is by examining some of the letters.
Yeah, well, I'll tell you, you know, there's this great quote from Buffett that surfaces all the time, which is something along the lines of, you know, if I was running $1 million or $2 million today, I could make 50% a year compounded. Yeah. And, you know, he goes as far as to guarantee it. Right. Yeah. And, you know, I get asked all the time whether I think that that's a plausible sort of idea in today's markets. And what I like to remind people is that, you know, and we get from Buffett in this time some case studies, which are really wonderful and rich. It's almost like you get this opportunity to look over Buffett's shoulder as he's investing. But, you know, there's a couple cases where he massively concentrated in micro caps. So, you know, the first one was a company called Sanborn Map Company, and he had almost a third of the partnership assets in that, you know, in the late 50s. And it had a, you know, I think $1.5 million in book equity. Right. It was tiny, you know. And then he came around and did Dempster Mill, which was in the early 60s, which is also a hugely concentrated position he took control of ultimately. But you know, that was also, you know, in the single-digit million. You know, market caps. So if you think about today, the inflation multiple would be like 7. So, you know, if it was, you're talking about like a $30 or $40 million company today for these guys, and think how small that is relative to, you know, what most people invest in. So these were underfollowed, tiny, sort of obscure, off the radar companies in which he was able to find and invest in. And I think I would imagine that he would do something very similar today, which would be to go where most professional investors can't, and look for some really mispriced assets.
In terms of a lot of the stuff that he learned from Ben Graham, and I see mostly in those Berkshire letters, there's a lot of references to economic moats, which could be anomalous behavior within the assets of a particular company, the ability to generate, I guess, excess returns relative to assets. How would he have been able to do that in investing in many of these smaller companies? Let's say if during the 50s, 60s, and 70s, and even the 80s, because even all the multinationals today are much bigger. They're like, multinational companies with billions and billions of dollars in revenue the world over. And it makes sense to me from the perspective that there's a lot of intangible components to be having very reputable, well-known names such as Coca-Cola and Gillette. But during that period of time, they weren't multinationals. They weren't necessarily the go-to product. In fact, many of these companies were innovators. So I wonder how the principles of, identifying cheap, great businesses would be applicable during the time of the partnership.
Yeah, so really during the partnership, we see a transition. And, you go from the early years, which is the cigar butt period where, whether it's a Dempster Mill, which is a windmill implements company in Beatrice, Nebraska, that's on the verge of bankruptcy. And, he sort of swoops in and repositions the assets and works the inventory down. I mean, time is not the friend of a business like that, right? And basically what he's doing is buying a company or an asset that is, priced as if it's on the, going out of business. And then, he resuscitates it into just a mediocre business and, gets the profit, right? And so that's the treadmill lifestyle of a Ben Graham disciple who's following his teacher to the letter, right? But Buffett migrates away from that over time, and at the end of the partnership, those final years, he had 40% of the portfolio in American Express.
Yes.
Right. So here's almost I see the period as sort of him sort of limping into the quality compounders, and really and he had Disney as well. He had owned 5% of Disney during the partnership years. He also bought National Indemnity for Berkshire Hathaway during the partnership years. So, we do see these migratory moves towards quality compounders, but it's slow. And I think it's really, in some ways, he had the best of both worlds because both American Express and Disney were not only good companies, but they were extremely cheap at the time that he bought them.
Did you identify any references to him identifying the value of things such as insurance companies due to their insurance floats? Because eventually he ends up acquiring Berkshire, a textile business, which he then utilizes the license of the insurance arm of Berkshire. Was there already hints and patterns of him noticing these interesting phenomenons as far as businesses are concerned that allow him to effectively create off a fund off the heels of basically an insurance platform?
Yeah, so the brilliance in my mind of Buffett in these early years is that, this was the time where it was the concept of that Graham had taught him, which is that, investing is best done when it's most business-like, and business is best done when it's most investment-like, really, I think is solidified for, Buffett in this time period. As an investor in a partnership, general partner, he was charged with deploying the funds that he had under management to their highest and best use. And then, he took over businesses like Dempster,
Yeah.
right? And also took the same philosophy, which is deploy the assets to their highest and best use. Ultimately, I think he realized quite early that all capital is fungible from one form to another. So, having a business with capital and inventory that isn't earning an acceptable return, that capital, that inventory can be repositioned to cash,
Mhm.
right? It can be sold. And then that capital can be redeployed, like to buy stocks, like he did, with the Dempster piece, right?
Mhm.
So the whole idea is that, business is just a pile of capital ultimately, and it's the job of the manager, whether it's a CEO or a portfolio manager, to deploy capital, to its highest and best use, and then to redeploy capital in the form of earnings that comes off the assets that are in place, also to their highest and best possible use. So, in the case of Berkshire, you had a business that was screaming for capital investment from its managers, but Buffett could not earn a sufficient return
Right.
on that incremental reinvestment, right? And so he didn't do it. And he didn't ever see himself as, quote, in the textile business because he owned Berkshire Hathaway.
Right.
He was in business, right? And the distinction is, go after and deploy your assets to their highest and best use. So he took money out of a bad business, which was Berkshire, and redeployed it into a good business, which was the insurance company, National Indemnity, that he bought from Jack Ringwald in, I think, 1968.
Have you had a chance to observe any of his more, I guess, more recent investments? And the one that comes to mind for me is ConocoPhillips. A lot of the principles, for some odd reason, I think I would argue that he kind of breaks a lot of his rules in the investment that he makes into Conoco, for many different reasons, basically buying assets that are effectively depleting, but probably still valuing those assets as basically fully priced, or at least him considering these assets to be continuously income producing, while in this case they were probably depleting. I thought that was one mistake of his. And then I guess the other, he was probably, as far as PetroChina is concerned, he probably used that. It was more of a trade, right? He was looking for some parity as far as fully integrated oil companies, as far as using China as a barometer for its depressed valuations. I don't know what your thoughts are on some of these investments.
Yeah. I think I got that. Although I missed a little bit in the center, but there's a couple things I would say that sort of come to mind when listening to you ask the question. One is that when Warren was doing, some arbitrage, some risk arb, Charlie said he wasn't very fond of it, but if it kept Warren out of the bars, then that's fine, right? So not everything is going to be a home run. And I think you've seen some of this, like with some of the commodity bets, and there was a similar bet in ExxonMobil,
Right.
Where I think he committed a few $1 billion to ExxonMobil in the third or fourth quarter of 2013, and then a year and a half later he was gone. I mean, one thing that I think I find really fascinating, here is that he tells you just as most recently as the annual meeting from this past May, that not only does he have no idea where commodity prices are going, this year, this month, or even a couple of years from now, he has no view as to the mid-cycle price of oil, right? And that really struck me, because if you don't have a view of mid-cycle oil, then how do you possibly value something like ExxonMobil or ConocoPhillips? And my suspicion, and I have no idea, this is really just a guess, is that those are effectively bond proxies,
Mhm.
right? And the yields are so rich relative to the fixed income alternative that that perhaps he was viewing them from that perspective.
Right, right. Another interesting thing I was thinking about was technological innovation and how he typically would try to steer clear of companies that, like, for example, the tech space. But as you know, right now we're in the year 2016, and things that were considered high tech, say maybe a decade ago, are pretty much like the norm now. I believe that he's dabbled into companies like IBM, which is basically just a big consulting company. But what comes to mind to me is the companies like Microsoft, for example, which pretty much are like almost staples to some extent, right, to people's business lives, for example. And I wonder at what stage he goes on to embrace some of these things, because all of these companies before that he invested, credit cards were relatively new, say, for example, in the 70s and 80s, as far as financial services are concerned. And I guess the today equivalent is like, web payment systems and Bitcoin or something like that. So I wonder where the stance is in terms of technology, and when do you just kind of like succumb to that as far as real requirements to everyday life, and how you can still start to invest in them as really great businesses, basically.
Right, right. So, one of my favorite parts of the partnership letters that Buffett comes back to over and over again is his definition of risk,
Right.
right? And oftentimes in modern day finance, we think about risk, or risk is thought of as beta, right? And that's how we quantify risk, and it's the degree to which a stock squiggles, over a given trailing period of time that determines its beta. And that's often the way people think about risk. And Buffett thinks about it very differently. He thinks of risk as not knowing what you're doing.
Yep.
Right. And so you have to have a real understanding of a business to be able to value it. Right. And if you really don't understand it, then you can't value it. And then I think what happens is, you look to the market to tell you what something's worth. And as soon as you do that as an investor, I think you're dead. Right? Because at least under the framework that Buffett operates in, right? The market has to be there to serve you. In other words, offer you up enticing prices from time to time, but it can never really be there to inform you. Right? And so when it comes to tech or healthcare or anything for that matter, and by the way, this will be different for everybody,
Right.
but you have to know the limits of your own circle of competence.
Yeah.
And I don't think that Buffett will ever feel like there's a time where he has to do anything. He couldn't find anything that was suitable to him in 1969, and so he closed the partnership as opposed to compromising on his principles.
Right.
And I would suspect that he would do the same thing again. I mean, so it's not really about being forced into anything. I think it's just a question of his own comfort level. And the question ultimately comes down to, is this a bond?
Yeah.
Right? So you go back, I think the first article he ever wrote for Fortune magazine was in 1978, and it was called How Inflation Swindles the Equity Investor. It's a fabulous piece that he wrote then. And in it, he talks quite extensively about how similar equities and bonds actually are. Right. And that, most companies over time mean revert in their returns on capital, et cetera. But I think Buffett's looking for, at least back in the partnership years, I think he was looking for a 15% equity bond.
Right.
So, if the current yield on distributable earnings over the price that he had to pay was something in the nature of 15%, and he thought that the company sort of would be able to generate that kind of earnings in perpetuity, he was all for it. Right. And so I think that's just the struggle with some of the technology companies, because the pace of innovation is so fast. Now, your point's well taken that maybe some of these are maturing, and maybe that's the reason why you are seeing them in a name like IBM today.
Yeah. I just think one of the inevitable trends, this is definitely a secular trend, is basically just greater overall like entropy as far as the markets are concerned, and faster pace, more rapid cycles of technological innovation. And unfortunately, you'll have to become almost very astute about what's happening in Silicon Valley as far as seeing like future businesses and how they develop, as we've seen with many of the pre-existing like listed companies right now in the tech space that have become almost like Amazon, for example, right? It's the largest retailer in the world, but you have to assess its financials and its value as well.
We hope you enjoyed this mastermind session. If you'd like to contact Peter Pham or Phoenix Capital, please email info@phx-cap.com.